Hello friends, Chris Lee, CPA here, back with another video for you. And today we are going to talk about how to decide which assets are most appropriate for gifting. Okay, so when it comes to estate tax planning, we're usually talking about gifting assets away to get them out of our estate. And gifting can be, to a trust, or it can be to direct individual, but usually we're going to be talking about gifting and what it looks like to give away our assets to our heirs. And there's kind of some concepts that we need to be thinking about to be most efficient with our gifting strategies and how to maximize our, integrated gift tax and estate tax exemption. And so we'll talk a little bit about, the factors that you might consider and the assets that make the most sense. So the first factor that we really want to be conscientious of is the appreciation potential of an asset. So factor one, appreciation potential. When we're talking about that, we're talking about how far the asset can grow before we die. Okay, so if we're starting with $1 million asset that could generate a 10% annualized rate of return for 40 years before we die, that asset could grow materially before passing away and be subject to estate taxes. But if it's worth $1 million today, then we can gift it away and only use up $1 million of our lifetime exemption. That's so that's the idea. We want to look at the appreciation factor of our assets. But that also means we need to consider the riskiness of our assets. So that's the second factor we need to think about. So when it comes to riskiness, we need to think about what is the likelihood that this asset will continue to appreciate, materially and predictably. Because if we gift an asset away that we assume has some high rate of return, and it ends up not being the case, the consequences is that we've gifted it maybe an asset that's worth $1 million, and then it maybe becomes worthless. Okay, let's say we gift an asset worth $1 million, it becomes worthless, and all of a sudden we've transferred an asset using up $1 million of our estate tax exemption that now has zero benefit to our heirs. So of our potential, 15 million, 30 million estate tax exemption, we've now gone ahead and made that. We've used it up to zero, or we've used it up $1 million of it without getting any benefit because the asset, declined. So when we think about the appreciation potential as factor one, we need to also consider the riskiness potential. So that's the important thing, to think about on the flip side of that. What's the likelihood it'll go to zero? Because if it were to go to zero or decline in value substantially, we use up a chunk of our estate tax exemption / gift tax exemption, the integrated system, without any benefit. So that's really what we want to think about. Additionally, when we're thinking about these assets, we want to look at assets that can be discounted. So assets for valuation purposes. So we can have an asset that's valued at a certain amount, but when we gift away, say, partial interests of an asset, so say we have a private business, it's worth 20-30 million bucks, but when we gift away smaller interests, the consequence can be that we lose lack of marketability on those smaller interests, or we lose lack of control. So say it's a wholly owned business we're gifting away. When we kind of break up the the units, that allows for us to have some discounts. Basically saying we're taking the value of the whole and saying it's not worth if we're dividing out the math across the shares, $30 million asset across all the shares, when we take a piece of those shares and move them along to our heirs, that those separate pieces don't carry quite the same value. One, they lose, they don't have control over the decisions of the business, and two, they might be subject to restrictions on the transferability of those units as well. And so that lack of marketability or lack of accountability or lack of control lets us take partial discounts on those assets. Usually they're in the range of 20 to 35%, 25 to 35%. Sometimes you'll see it up to 40%, just depends. But the idea here is that if you have assets that maybe you wholly own, you can generate discounts by gifting partial interests to multiple trusts or heirs, breaking up the whole into component pieces. From an ownership perspective, not necessarily dismantling the business, you can create some valuation discounts. So you have appreciation factor, riskiness factor. We've got your discount factor. We need to look at the capacity for the asset to be transferred, as some assets are not able to be transferred. So when we think of that, that could be certain retirement accounts like IRAs. You can't gift those away during your life. Certain units, shares of ownership in businesses or stock options may not be able to be transferred. And then if you're talking about ownership in maybe say an LLC that's taxed as a partnership, operating agreements can have restrictions on the transferability of shares. And the reason that is because under general contract law, you can't force someone to be in business with someone without your approval. So depending on what the operating agreement says, you may have restrictions there. When it comes to this, we want to think about assets. We want to think about any carryover items, tax attributes that may be connected to that asset. So that would be, say a fifth, a fifth factor that we would want to be conscientious of are any tax attributes connected to it. So say you've got a piece of rental real estate that has accumulated losses that you haven't been able to use. When we gift the asset away, say it's a piece of real estate, the tax attributes, those accumulated losses, which would have ordinarily been income tax deductions, like against ordinary income, what happens is those actually attach to the quote unquote basis of the property, which is to say the hypothetical cost of the property that we're transferring. And when we gift assets away, they have a carryover basis. What we've effectively done with that kind of rolling it into the basis is we've converted what would have been an ordinary income tax deduction into a capital, reducing capital gain in the future. That can have material, tax inefficiencies for our heirs and potentially in the trust. And so we want to be conscientious of the assets tax attributes that may be connected to it. And that also is, being conscientious of assets with, certain amounts of tax basis. Generally, we want to gift away assets with a high tax basis, because when you pass away, assets held in your estate get stepped up to fair market value, which is to say we get this hypothetical assumption that these assets, are, worth that you've paid more for them on the date of death. That transfers to your heirs. And when that happens, that means they've got a future, a reduced gain in that asset in the future when they hold it and sell it later. So when we gift assets away, we want usually higher basis assets, because we don't want to minimize that tax-free benefit of the step-up basis. But so we want to just manage the tax attributes of the assets that we're gifting and be conscientious of those. We also need to think about the liquidity after the transaction. So if we are gifting away assets, we want to make sure they're not assets that we are using to provide us liquidity to live. So gifting stock might make sense, but if you're living off of the dividends from that stock, gifting the stock does not make sense in practice. So it looks like you're getting an appreciating asset out of your estate. However, once it enters the trust, you don't get asset. You don't get benefits of that. Once it enters an irrevocable trust, that does the job of getting it out of your estate. So also to think about, if you were to maybe gift your primary residence to a trust, which generally not recommended, but you could do. If you were to gift your primary residence to the trust and you still need to live in that residence after the gift, you're going to have to pay rent to the trust. So And then when you're paying rent to the trust, you're creating income tax consequences to the trust. So then you've got to gift cash to pay the tax consequences for that rental income that comes into the trust. So some concepts we need to be conscientious of is the liquidity, both of you personally and potentially the liquidity of the trust, and making sure that's not creating some sort of burden, unexpected burden along the way. And then when we're thinking about other issues, we need to think about potentially when it comes to real estate, really special issues related to any asset. But particularly with real estate, the next factor would be dealing with special issues related to the asset. So in certain states, when you transfer assets, they get revalued for real estate tax purposes. So what you might end up doing is you have an asset that maybe a piece of real estate that did not have you gift real estate that had a lower value for assessment purposes, that then has a higher value, and so it increases the real estate taxes. Throw that in a trust, and all of a sudden you create a potential liquidity issue within the trust, and so you might have to be gifting more assets to keep the trust kind of afloat. So then you're going to be having an unintended consequence of even more gifting potentially. So that kind of covers a few of the things that you need to think about when it comes to gifting. So again, the appreciation value potential of the asset, the riskiness of the asset, how likely it is you can have a discount on the asset, which is our third factor. We've got the fourth factor, which is the ability for the asset to be transferred. Certain assets just won't be able to be transferred, certain LLC interests, certain, stock or stock options, or retirement accounts. Those assets aren't going to be eligible. We need to consider the income tax attributes of the assets, which is to say any carryover items or basis items that might be involved there. We need to consider our post-gift liquidity, making sure that we're not creating a problem with the capacity for that income post-liquidity. Or rather, for the grantor, the person, moving assets out of their estate, we need to make sure that their liquidity is covered, that you're not transferring assets that are currently contributing to your lifestyle, because once they enter the trust, you no longer going to have access to them. And then we need to consider any special issues that might occur that might be related to a specific asset that we're talking about transferring. So usually that's going to be real estate. What's going to happen there? From a real estate tax perspective, and kind of related to the post-gift liquidity sort of question, the sixth factor, you may end up needing to pay rent to be able to continue to occupy the residence. So the assets that are really best suited for transferring are usually publicly traded stocks. They're high growth potential, partnership interests or fund interests, privately held stock, maybe stock that's eligible for qualified small business. This is where we can talk about qualified small business stacking. Commercial real estate, you can do personal use real estate, but usually you don't want that to be leveraged, and you want it to make sure that it's not that you're not going to maybe continue to use it or that sort of thing, or that you're going to transfer the residence with some cash to be able to deal with the tax consequences within the trust. So that's just the ideas of assets that we want to be thinking about. You could, potentially put bonds in there, but they're kind of a higher basis, lower growth asset. And that's typically, that can be good for gifting purposes. But they don't have quite the same growth potential. But also, you can do crypto, but given the volatility of crypto and the type of asset, it could be, when we're talking about that volatility factor, that may be a good opportunity to gift at a lower valuation, depending on when the gift is being executed, and let it appreciate. However, because of its riskiness factor, it might not be a good candidate. It's just realizing, like, how much are we gifting and what are we doing? What are the goals of the assets and that sort of thing. So I'll leave that video there. There's a kind of the 7 factors we want to think about when we're thinking about gifting. And I will, if you want to talk about any gifting strategies or how to, any income tax or estate tax planning issues, feel free to click on the link below. Happy to connect with you directly, or financial advisors that maybe have questions regarding their clients. Happy to connect, and I'll have a new video for you soon. All right, take care. Bye-bye.